Welcome back everyone, my name is Angelo. The habit of saving and investing can be life-changing long-term, allowing you to be more relaxed about your finances and unexpected situations like the sudden loss of your job. With a high enough savings rate, you might even be able to retire early one day if that's a goal of yours. Okay, sadly it's not that easy. You still need to make sure you avoid a few major mistakes with your money. Oftentimes we dive headfirst into investing with limited information, which causes most people to make stupid decisions. I was not immune to this either, by the way. I've also made some of these mistakes throughout my own investment career. Which brings me to today's topic, 7 hard truths about investing most people ignore. Let's dive right in, starting with number 1, which has to be inflation. Due to inflation, goods and services get more expensive over time. I'm sure you noticed this yourself, especially over the past few years. While I believe we'll see inflation going back down to an average of 2 to 3% per year, you still want to find ways to maintain or if possible grow your purchasing power over the long run. Don't make the mistake of keeping all of your money in the lowest risk assets like government bonds or earning a few percent per year in interest on your bank account if your bank even offers that. Look, I know that Trade Republic started paying 4% per year on uninvested euros secured by 100k bank deposit guarantee, which I certainly won't complain about. My wife and I also use them to earn interest on our own cash reserves. The link is down below in the description, by the way, if you'd like to support me. Having said that, euro interest rates set by the ECB are unlikely to stay this high forever, and 4% per year are still significantly less than the average returns in the stock market, which were closer to 7% per year historically when looking at low-cost, well-diversified global ETFs like my personal favorite, the Vanguard FTSE All-World. Obviously, these come with lots of ups and downs, so you should have a time horizon of at least 5 years, ideally 10 years or more, when investing into stocks via ETFs. As long as you keep that in mind, ETFs have been an excellent protection against inflation long-term. As you can see here, when looking at the MSCI World since 1979, before and after inflation, or the FTSE All-World since 2003. Number 2. You need to forget about getting rich quickly when it comes to investing. It's not going to happen. So ignore all the scammy ads promoting free webinars trying to sell you expensive trading courses or anything like that. The only person getting rich in that scenario is the person selling them. What you need to realize is that you're a lot more likely to hear a story about that one individual among a million that managed to get rich quickly by taking on an extremely risky bet. At the same time, you won't hear anything from the 99.99% of people that failed and lost all of their money trying something similar, since that story is a lot less sexy to talk about. Third, you need to keep emotions out of investing. Most people tend to get excited and invest more when the market has recently gone up a lot and invest less, or worse, pull their money out when it has been going down. Meanwhile, experienced investors do the opposite. Look, I'm not gonna lie, of course it feels better when your portfolio is in the green. But rationally speaking, if you're investing long term and you're still adding more money anyway, you should be happy whenever you're able to get more shares at a lower price. The market has actually seen a decent correction as we speak. We're currently 7% off its all-time high set at the start of 2022 after a difficult last year in part due to higher inflation and high interest rates set by central banks. But like every crisis that came before, this too shall pass. When in doubt, I find it useful to zoom out to see what happened after similar corrections in the past. And while the old saying time in the market beats timing the market is true statistically, there's nothing wrong with you splitting a larger amount you were planning to invest into ETFs into smaller chunks and to invest these at regular intervals over time instead of all at once. Especially if you're feeling nervous about the current situation, a cost averaging strategy like this could help you sleep better at night. Over time, as you get used to market volatility and you experience firsthand how it feels when your portfolio is either up or down, you'll learn the value of sticking to your long-term investment strategy and to keep emotions out of it, no matter what the latest news headline is trying to scare you with this time. Now, on to our 4th point, diversification. You've probably heard the saying, don't put all your eggs in one basket. That's certainly true for stocks, where investing into a single stock could cost your entire investment if the company fails. But even just focusing on stocks from a single country could be a mistake long term. At the start of the 20th century, the most successful companies were still based in the UK, followed by the US, at the end of the 80s Japan, and now the United States has been back in the lead for a few decades. There's no way of knowing ahead of time which country is going to outperform in the future. So in my opinion, it makes a lot of sense to diversify globally instead of going all in on stocks from a single country. Luckily, this can easily be accomplished via a single low-cost ETF, like my personal preference, the Vanguard FTSE All-World. And if you only want to invest into developed markets across the globe, I would pick a FTSE Developed World or MSCI World ETF. While this could already be enough to cover the riskier part of your portfolio. ETFs currently make up around 75% of mine, just to give you an idea. You could also look at adding other investments. My personal preference is a mix of peer-to-peer lending for extra cash flow, as the sector has very little correlation to stocks, and a bit of Bitcoin and Ethereum as a personal high-risk bet of mine, which so far helped my portfolio grow faster than it would have otherwise since 2017. You can of course also look at real estate either physically or via real estate investment trusts, aka REITs, for extra diversification. By the way, you can find the best low-cost brokers for ETFs as well as the P2P platforms I use linked down below in the description, which is a great way to support me if you'd like to. Also, don't forget to subscribe if you haven't already. We're trying to reach 30,000 subscribers by the end of the year. Let's see if we can make it. Fifth on our list is trend chasing, which is a very bad idea. Just over the past few years alone, we've seen so many trends come and go. Remember the hype around wheat stocks, electronic vehicle manufacturers like Tesla, or when everyone kept asking me about Katie Wood's ARK Innovation ETF and where you could buy it as a European just 2 years ago? Surprisingly, I haven't heard anyone ask me since. I wonder why. And now in 2023, we see everybody jumping headfirst into anything that's related to artificial intelligence. Don't get me wrong, I'm also bullish on AI and think it will revolutionize a lot of businesses around the world, but there's no way to know today who the winners and losers will be. As a result, I would once again just stick to buying and holding a well-diversified ETF, which is very likely to outperform betting on single trendy stocks or concentrated sector ETFs over the long run. Moving on to point number 6. Very few investments marketed as being able to generate passive income are truly passive. I certainly wouldn't call an investment into physical real estate or many other options popular finance YouTubers mention in their videos passive investments. Most of the options they mention are usually just side hustles requiring a ton of unpaid work upfront in hopes of generating cash flow later on. You can check out this video of mine if you're interested in my reaction to a few of them. I'm only aware of a handful of investments that have the potential to really generate passive income if that's your goal. First, dividend-paying stocks, which are once again easiest to cover via ETFs. Second, real estate investment trusts, or ideally ETFs containing a large number of REITs, instead of all the work and capital that's required to buy your own rental properties. Third, peer-to-peer lending, as long as you stick to platforms with a reliable auto-invest. And lastly, due to the high interest rate environment we're currently in, we now also have 2 low-risk options with decent yields. Cash deposits paying 4% interest per year secured by a 100,000 euro bank deposit guarantee, and euro government bonds yielding over 3.5% per year, both of which have recently become available on Trade Republic, linked down below. This brings me to our 7th and last hard truth: the danger of assuming that the current circumstances, especially during a crisis, are going to persist forever. Let's look back at the period during COVID, for example. Many believed that we would now be using tools like Zoom indefinitely to replace most face-to-face interactions, or even that we would see a lot less travel and that almost nobody would be working in an office anymore, all of which turned out to be wrong. Sadly, these assumptions led a large number of people to make poor investment decisions. The same was true regarding inflation. When inflation reached its peak, everyone seemed convinced that it was going to remain that high for a long period of time. And yet we're almost back to pre-crisis levels a year later in the US, with inflation in Europe lagging a bit behind but also trending lower, so hopefully we're not too far off. Or after central bank interest rates had been so low, most of us, me included, also assumed we would never see rates as high as 4%, and yet here we are today. What I'm trying to say is that it's very easy to fall into the trap of assuming that whichever crisis is going on every couple of years is going to persist indefinitely. But history has shown us that's not the case. So far we've always recovered. As a result, it's generally not a good idea to make long-term investment decisions based on emotions and fears you may feel during periods of uncertainty. Founded on my own experience as an investor since 2017, I can honestly tell you that it never once felt like it was the perfect time to invest. There was always something to worry about. Yet today I'm feeling grateful that my wife and I started investing 7 years ago and let none of the scary news headlines over the years influence our investment strategy, which is focused on the long run anyway. But now I want to hear from you guys. Which of these mistakes did you make so far? Let me know in the comments and be honest. Before you take off, don't forget to subscribe so you don't miss out on some exciting upcoming finance videos. Meanwhile, if you'd like to support me, feel free to use my links to all of my favorite investment tools in Europe in the description below. And please keep in mind that none of what I mentioned today was of course meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.